The economic situation is not one which looks positive for the foreseeable future. Many of the current issues, like the lack of a solution for jobs, just won't come about in 2020. Stimulus measures are not solutions, of course, and must eventually be paid back. Knowing that higher taxes is the only way to wind down the amount of debt in place, economic growth, which was already trending down, is sure to slow even further. But don't let me try and convince you. Look at the data itself. You came here for the truth, so let me unveil that for you. On this channel, we look at the data. You and I, that's what we both want. We don't want opinions. We don't want jargon. We want it as simple as it possibly can be because that's the truth. Today, we're going to talk about the fact that there are no jobs for so many individuals out there. Several industries have been destroyed, and you look out into the future, the prospects aren't so good. The money situation as a result of what's happening with the jobs, as a result of the inflation, my goodness, if you look at food and other things that I showed you just a few videos ago, there has been such an increase right now for different reasons, obviously, but it seems like it will persist for the next little while. And then, of course, big debt. On top of all of that, people are accumulating debt, and that is never a good thing. Yes, we see interest rates remaining very low, and that's a good thing for if you have a lot of borrowing, but you don't want to be carrying such massive debt, especially when we're talking about the worst kinds of debt, and that's credit cards and things which don't seem to be getting any of the benefits of that low interest rate environment. You're borrowing at 17%, you're going to be hurt. I want to cover the economic side today, and then we're also going to cover some interesting statistics about the stock market and what's happening in the financial system. So stay tuned until the end. Let's go. The black hole of unemployment benefits. 6 months into this, and some are still waiting for aid. I don't know what they're doing to make ends meet, but for many people, just a paycheck or two is enough to break them. I have shown you study after study that shows somewhere between $200 to $400 is enough to break them. They will have to go and sell something, they will have to go get another job, they will have to go in debt simply by increasing their expenses by $200 to $400. That means they are right at the absolute edge. And there's nothing wrong with that for people who continuously receive employment and their expenses do not increase. But I see a problem with one or even both of these right now, especially. I have told you so many times before, look, if everything continues the way it is, you're fine. But there are always events that occur along the way, something might break. And people said all the way up in 2019, nothing's going to happen, nothing's going to happen. They said the same exact thing in the early part of 2020, but something snapped. And then, of course, the market came down. And on the way up again, we've only had a handful of stocks that have been able to benefit from all the stimulus. In this process here, a lot of these companies have been laying people off, and you know what's going on after that. The recession has stressed states' ability to pay timely unemployment benefits, resulting in financial hardship for many families. Nearly 400,000 people who received their first benefit payment in July had waited at least 70 days. For some people, that's too long. That's why you see those food bank lineups. That's why you see such hardship today. But as I said in the introduction, providing these stimulus measures is not the solution. We need people that are actually working steadily, consistently, and hopefully over time, their wages are increasing. That's a whole different story, though. This is the problem that we face today, and truly, unfortunately, it doesn't seem to be happening. There's a couple charts associated with this. The delay in unemployment benefits, the share of workers paid within 21 days of applying for jobless benefits has dropped precipitously in recent months. So this chart is basically just showing us from January, which is here, and then all the way to August, and you could see what has happened during this period. Not very good. The states themselves are bankrupt, and I'm not sure how this is going to turn around. Employment by income level. So this was interesting because you can see that, as usual, the bottom wage quartile, less than 27,000, there really isn't a V-shaped recovery. They suffered the biggest drop and have yet to come back up. If I look at this, it's approximately, maybe 15 or so percent into the negative. That's the change in employment rates. And that just gives you an idea. You look at San Francisco, it might be different from a place in, let's say, Alabama or in Ohio or wherever. There's always pockets, right? But we can break it up and look at these, and it provides some useful information. I do believe that some of those in the top wage quartile or the middle wage quartile will be feeling it over the next several months. Their issues have yet to surface. Employment by industry, change in employment rates showing you professional and business services, education, and then you go all the way to the bottom there, leisure and hospitality. You know what's been happening. As a result of this, nobody's traveling, nobody's doing what they were before. Restaurants, as we get into these colder months, big issue for a lot of cities. I really don't know how this is going to get any better. Here you can see the massive labor income losses worldwide. The ILO provided this analysis of the labor market impact of what we're seeing here in 2020, and they revealed a massive drop in labor income and a fiscal stimulus gap that threatens to increase inequality between richer and poorer countries. You and I both knew this already, but now the data is in. It shows us here. I'll forward over to that in just a second. Here is the information directly from the source. The International Labor Organization provides this. It's coming as of September 23rd, and there's too much to get into, but I'll highlight a couple points. Workplace closures continue to disrupt labor markets around the world, leading to working hour losses that are higher than previously estimated. Working hour losses are expected to remain high in the third quarter of 2020 at 12%. And then at the bottom, fourth quarter estimated to be 8.6%. We'll see what happens because they're expecting a recovery. Remember that. Maybe not a V shape, but they're expecting that to continue. Along the way, there are absolutely disruptions that will occur and they are not being accounted for. These high working hour losses have translated into substantial losses in labor income. They get into a lot more in here, but there's too much to cover. I'm already going on too long. Let's move on. It's too risky to put new money in stocks right now. That's according to Wells Fargo, right? We see a lot of different indicators. We see a lot of different analysts, and I'm interested in what they have to say, not because I'm going to believe it, but it gives me some food for thought. He believes that the market is too vulnerable to another correction and a 50% surge in volatility. There has been a lot of attention put on 2020 for so many different reasons. Despite this, we have noted that the tech stocks have risen considerably. The economic situation, totally different. What I am looking for is the things that I have covered many times before: commercial mortgage-backed securities, corporate debt, and the fact that the Federal Reserve and the government itself has already pumped so much in and we're barely getting anything out. That's not a good sign. There was an article from Real Investment Advice, and they had a few charts along with it. I wanted to bring it to you. Essentially, what they're noting here in this one is the fact that the market came down earlier this year, and it was rather dramatic, as you know, broke a lot of records on the way down. This time, however, as we see the market breaking down, it wasn't as dramatic. They are saying that this is considered to be a healthy correction. The RSI, as you can see, way overbought, and now that has come down to more reasonable levels. This chart here shows you that the VIX index, or at least that's what I presume, because it's showing you the Volatility Index new methodology. I assume that's referencing the VIX, although they do have their own measures of volatility. Regardless, volatility has not surged during this period of time. If you compare that to what we saw earlier in the year, obviously it spiked up significantly. They also mentioned what's going on with the US dollar. We are currently going to avoid international, emerging markets, basic materials, and industrials. These areas are subject to a rally in the dollar. Given the hugely negative sentiment in the US dollar, we have been warning for several weeks that a counter trend rally was likely. So when everybody's bearish, chances are things turn over at some point. Now, Societe Generale had this to show us, and I believe it's something that if you're on this channel for a while, you've heard me talk about it 1,000 times before, but they are discussing the link in between the S&P 500 and the Federal Reserve's balance sheet. I don't need to harp on about this, but left-hand side, it's comparing that between 2008 and 2020, and on the right-hand side, between March 18th and September 16th, 2020. Overall, you do see that connection. It is very clear. Throughout the periods when you lose that support indirectly, because they may not be buying the stocks right away, but the money flows through and it pumps it up. Regardless, look at it. It's hard to deny. Essentially, what they look at here is buying simply based on what the Federal Reserve is doing. In doing so, this chart here as well as this one, you see the growth. On the right-hand side, cumulative returns of benchmark strategic equity cash portfolio and strategic plus tactical Fed asset growth alpha from 2009 to 2020, unquestionably doing what the Federal Reserve does provides you with better returns. That should not be a surprise to anybody who's on this channel. You and I both know I have done many videos about it, and it just shows you how these markets are entirely controlled. Few things very quickly. Market volatility prompts investors to seek out long-short equity. Stretched valuations and the resulting pullback in equities have prompted more interest in long-short fund strategies that can provide some protection against market declines and wild swings. I think this is important simply because of the fact that there was not even the suggestion that the market could go down just a few weeks ago. Now today, different story. San Francisco's housing has cooled as some flee the city, but the demand is still there. This is one that is truly mind-boggling because you have the big tech companies, the trillion-dollar companies that are here, all the unicorns that exist, billion-dollar companies with nothing more than an idea, huge speculation on homes, and so much more. And then you have extreme poverty. You have people that really cannot afford to live in these places. It's so unbelievable. And to finish the video off, ex-Deutsche Bank gold traders found guilty in spoofing trial. I've talked about this numerous times. You know what's going on with the precious metals markets. They manipulate the heck out of them, and there is more and more evidence showing that every single day. That's all for this video. If you found it informative, hit that thumbs up button. When you do, you are supporting me. All you gotta do is click one button and you help me out. If you want to learn how to sell stuff online, you can do so by purchasing a course. There are many good courses for $1,000, and now I just saw one that increased their price to $2,000. They are likely very good. Some of them are anyway. If you want to learn for free though, you can do so at the AmazonGPS.com. Do you want to understand the financial system from top to bottom? You want to ask the right questions. You want to take care of your financial situation. You've got to read these two books. They will certainly be of assistance for you, and then you could pass them on to family members or friends. Check it out at the link in the description if you want the audiobook instead, themoneygps.com. Wait a second, don't go anywhere. Have you seen this video? Lots of good stuff. Definitely check it out. I'll see you there.